With exactly $17.2 billion in quarterly revenue, IBM suffered a brutal 25.2% stock price collapse in a single day. The market panicked over delayed deals, sending shares plummeting to $217.1. But is Wall Street completely missing the structural cash generation hiding inside IBM right now? When you examine the $4.8 billion in free cash flow, the illusion of a broken business shatters. Headlines are screaming about the sudden sell-off, focusing almost exclusively on missed short-term expectations. At first glance, the crowd assumes IBM lost its edge because overall revenue only grew 1%. But digging into the net cash from operating activities of $7.8 billion, you realize company generates massive liquidity. This disconnect between daily chatter and actual cash generation reveals a resilient model built on recurring enterprise contracts. The true driver of this valuation is how IBM converts complex contracts into capital. You can easily check this by looking at the operating gross profit margin of 59.4%. This metric proves that despite revenue headwinds, the core pricing power at IBM remains firmly intact. The underlying profitability of their specific services, like hybrid cloud deployments, is not collapsing. Instead, IBM maintains immense leverage over its enterprise clients, allowing the business to preserve its capital base. To fully grasp why this sell-off happened, we must analyze the 7% decline in infrastructure revenue. Most analysts focus purely on this drop, assuming clients are abandoning IBM mainframes entirely. They see this infrastructure revenue decline and conclude that legacy hardware, like heavy physical servers, is dying. However, the fundamental reality is tied to a specific capital expenditure shift across the broader technology landscape. Corporate clients did not permanently cancel their long-term infrastructure contracts with IBM. Instead, they reprioritized budgets towards supply-constrained servers and memory to build new artificial intelligence ecosystems. This dynamic simply pushed traditional computing deals at IBM further to the right. We see the actual strength of the hardware cycle when looking at the Z17 mainframe program retention rate of 130%. This incredible retention rate means clients are actually expanding their capacity on IBM systems, not abandoning them. The core mechanism here is project timing, not a structural loss of market share. Customers still rely deeply on company for critical computing needs, but they delayed upgrades to secure immediate AI hardware. This short-term delay created a massive pricing inefficiency in IBM stock, which patient investors can exploit. Let us look closely at the software revenue growth of 5% to understand this hidden strength. Wall Street is entirely captivated by delayed deals, ignoring the acceleration in the critical growth engine for IBM. When isolating the open-source cloud segment, we see Red Hat revenue growth hit a remarkable 11% sequentially. This is exactly where the real structural advantage lies for company. Red Hat is the foundational software layer, allowing major banks to run applications seamlessly across different cloud environments. The consensus view sees a legacy business, but the 11% Red Hat revenue growth proves IBM is positioning itself at the center of modern architecture. When clients delayed traditional mainframe purchases, they poured money into other physical assets, driving distributed infrastructure revenue growth to an unprecedented 37%. This segment includes critical hardware like power systems and physical storage arrays. IBM exited the recent quarter with a distributed infrastructure backlog of $500 million. This $500 million backlog represents locked-in future revenue for IBM, providing immense visibility into upcoming operational quarters. Investors selling IBM today are completely ignoring this guaranteed future cash flow. How is the company managing its bottom line while navigating these delayed contracts? The answer lies in the non-GAAP diluted earnings per share of $2.93. A massive stock drop usually suggests collapsing earnings, but this non-GAAP diluted earnings per share actually represents a solid 5% increase year over year. IBM is growing its bottom line profitability even when top-line deal closures temporarily falter. This happens because IBM is continuously optimizing its cost structure and expanding operational margins through internal productivity initiatives. We see this discipline reflected in the non-GAAP pre-tax income margin of 19.2%, which actually expanded by 30 basis points. Grasping this underlying margin expansion, you will start to view financial reports in a completely new light. IBM is not just cutting costs, the company is deploying heavy capital into the future. Consider the newly announced Lightwell security investment of $5 billion. IBM is deploying this $5 billion commitment to build a trusted enterprise clearinghouse, utilizing over 20,000 engineers to secure open-source software vulnerabilities. This new initiative directly addresses the rapidly evolving cybersecurity concerns that actively distracted enterprise clients this quarter. By investing heavily in solutions like Lightwell, IBM creates an entirely new revenue stream, while solving bottlenecks that delayed recent deals. This proactive capital allocation proves IBM is playing a much longer game than quarterly speculators realize. To truly value this company, we must look far beyond the current quarter. We must actively examine the staggering quantum computing investment of $10 billion planned over the next 5 years. Most casual observers view quantum computing as a distant science project, but IBM treats it as a near-term industrial reality. The company is actively building a pure-play quantum wafer foundry, committing massive internal capital alongside major government incentives. This $10 billion quantum computing investment positions IBM to dominate the next era of computational power by 2029. We must evaluate these massive capital deployments within the context of our current macroeconomic environment. With the United States inflation rate of 3.5% keeping prices elevated, expensive capital forces smaller technology companies to scale back ambitious expansions. Because the federal funds rate sits between 3.5% and 3.75%, smaller competitors simply cannot afford to finance massive hardware projects. IBM, however, has the fortress balance sheet required to fund generational technology bets while others retreat. We also cannot ignore broader consumption trends like the United States retail sales growth of 6.9%, which prove the consumer base remains highly active. Retailers and global banks must continue scaling back-end infrastructure to handle this relentless consumer demand. These massive corporations cannot permanently delay their fundamental technology investments without risking major operational failures. The delayed deals from this quarter will inevitably close, simply because the underlying economic activity demands it. This temporary pause in corporate spending simply created a coiled spring effect for IBM, pushing guaranteed revenue into future quarters. Did the market completely misprice the recent earnings report from IBM? The absolute truth is that the $17.2 billion in revenue and the delayed contracts mask a deeply resilient, highly profitable enterprise. While frantic traders reacted purely to the timing of specific deal closures, they completely missed the structural cash generation and immense hardware backlog sitting within IBM. The core analytical takeaway here is that temporary capital expenditure shifts do not destroy long-term competitive advantages. For the rational, forward-looking investor, the current valuation of IBM offers a profound margin of safety. This is not a dangerous value trap. This is a long-term compounding machine temporarily disguised by intense market volatility. By focusing strictly on fundamental data, you can ignore the daily noise and see the undeniable value hidden inside IBM. I want to hear your take on whether the delayed enterprise deals represent a permanent loss of market share or if this is the perfect entry point. Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.